So the United States bombed Iran. Markets panicked. Oil spiked 13% in a single night. And 99% of retail investors did exactly what they always do. They sold, they froze, or they chased oil stocks at the absolute peak. All three of those moves were wrong. And Ray Dalio, who has navigated every major geopolitical shock since 1973, made not a single reactive trade. But here's what nobody is telling you. In every major conflict of the last 50 years, the Gulf War, the Iraq War, Russia-Ukraine, the investors who panicked lost money, and the investors who understood the pattern that repeats every single time made generational wealth. The Iran war is following that exact same pattern right now, and the window to position correctly is measured not in weeks, it is measured in days. Ray Dalio's playbook for geopolitical shocks is the most precise framework for understanding where money actually moves during a conflict. Not where the headlines say it moves, but where the capital flows actually go. What he said about the three phases every conflict produces, and the one asset class that has outperformed in every single geopolitical shock in 500 years of recorded history, is something every investor needs to hear before that window closes. Subscribe now. Here is exactly how the money moves, and where smart investors are already positioned. On the night of February 28, 2026, Operation Epic Fury began. US and Israeli strikes hit Iran. Supreme Leader Khamenei was killed, and within hours, the financial markets delivered their first verdict. Brent crude surged 13% in a single session, its largest single-night move since the Gulf War. Gold crossed $5,300 an ounce. The Dow futures dropped 600 points before the market even opened. And retail investors, watching their screens at midnight, made the same mistake they have made every single time a conflict has started in the last 50 years. They sold. Here's the number that should stop every retail investor cold. According to Morgan Stanley's analysis of every major geopolitical conflict since 1945, markets have historically posted gains during wartime, including double-digit increases during both Gulf Wars, in the 3 to 6 months following the onset of conflict, led by the defense sector. Not down, up. And the investors who panic sold at the shock moment missed every single dollar of that recovery. The pattern doesn't change. The panic changes. The pattern never changes. And this is where Ray Dalio's framework becomes the only framework that actually matters. Because Ray Dalio doesn't see a war when he looks at the Iran conflict. He sees a debt cycle stress test with 3 distinct phases, each one producing a specific set of winners and losers, each one creating a window for investors who understand the mechanism, and close that window permanently for investors who react to headlines instead of patterns. Phase 1 is the shock phase. This is what happened on March 2nd, the morning after the strikes. Oil spiked, gold surged. Defense stocks, Northrop Grumman, RTX, Lockheed Martin, gained 6%, 4.7%, and 3.4% respectively in pre-market trading. Airlines collapsed. American Airlines down 4.2%, Delta down 2.2%, United down 2.9%. Air France fell 9.4%. The VIX, the fear index, spiked. High-growth tech stocks sold off as capital rotated into perceived safety. Here is the critical insight about Phase 1 that 99% of retail investors get wrong. If you bought oil at the spike, you bought the emotion, not the asset. Bank of America's analysis of every major geopolitical shock over 90 years shows that oil, the best-performing asset during geopolitical conflicts, averaging 18% gains, gives back most of those gains within 6 months. The traders who bought oil at $71 on the night of March 1st bought the fear, not the opportunity. Phase 1 lasts days, sometimes 2 weeks. The window to make the correct moves is not in Phase 1, it is in what comes next. Phase 2 is the repricing phase. This is where institutional money, the money that manages trillions, not thousands, stops reacting and starts positioning. The questions being asked in Phase 2 are not whether the war will escalate. They are structural questions. Is the oil supply disruption temporary or permanent? Is inflation now structurally higher for the next 12 months? What does a sustained Hormuz closure, even a partial one, do to the Federal Reserve's rate trajectory? Which sectors benefit from a prolonged conflict that nobody has priced yet? JP Morgan raised its gold price target to $6,300 per ounce by December 2026, not in Phase 1, at the moment of maximum panic, but in Phase 2, when the structural analysis was complete. Wells Fargo strategists mapped out scenarios from rapid de-escalation to prolonged Hormuz closure. Their base case still targets the S&P 500 at 7,500 by year-end, 9% above current levels, with defense, energy infrastructure, and gold as the primary sector winners. Phase 2 is where the money is made, and Phase 2 is where most retail investors are still paralyzed by the headlines from Phase 1. Phase 3 is the rotation phase. This is where the structural winners separate permanently from the structural losers, and where the investors who understood the framework in Phase 2 collect the returns that the panic sellers in Phase 1 will never recover. And this is where Ray Dalio's specific framework becomes essential. Layer 1. The energy infrastructure play, not oil itself. The mistake retail investors make is buying oil companies at the spike. The correct play, confirmed by every major geopolitical cycle Dalio has studied, is the infrastructure that moves oil, not the oil itself. Pipeline companies, storage terminal operators, LNG regasification facilities. These companies collect a toll on every barrel that moves, regardless of whether the price is $70 or $100. They do not need oil at $90 to be profitable. They need oil to keep moving. And in a conflict that has disrupted the Strait of Hormuz, increased the demand for alternative supply routes, and forced buyers across Europe and Asia to source LNG from new terminals, the infrastructure operators are the most asymmetric opportunity in the energy sector right now. ExxonMobil gained 4%, Chevron 3%, ConocoPhillips 5% on March 2nd. The pipeline and storage operators moved less visibly because retail attention was on crude prices. That discrepancy is where the opportunity lives. Layer 2. The defense structural rotation, not the spike stocks. Lockheed Martin is up 5% on the day of the strikes. RTX is up 4.7%. That move is the Phase 1 emotion trade. The structural defense play is different. Morgan Stanley confirmed that military escalation leads to higher U.S. defense outlays and larger deficits, driving multi-year procurement cycles, not single-day spikes. Governments do not order one missile. They sign 10-year contracts. The backlogs at Lockheed Martin, Northrop Grumman, and Palantir, whose AI-driven defense systems are now embedded in every major U.S. military operation, are measured in hundreds of billions of dollars. The Global X Defense Tech ETF delivered 72.8% in the 12 months before the Iran strikes. The structural case for that ETF was already in place before February 28th. The Iran conflict accelerated the timeline. It did not create the thesis. Layer 3. Gold. The one asset that outperforms every conflict, in every cycle, for 500 years. Bank of America's data is unambiguous. 6 months after a geopolitical shock, gold continues to outperform by an average of 19%. Not oil, not defense, gold. Why? Because gold is not an energy trade. Gold is a monetary credibility trade. Every geopolitical conflict in the late stage of a debt cycle, which is precisely where the United States is today, with $36.2 trillion in federal debt, $1 trillion in annual interest payments, and a central bank that cannot cut rates because tariff-driven and now oil-driven inflation is keeping CPI above 2.9%, puts additional pressure on the monetary system. Gold is the asset that benefits from that pressure systematically, not episodically. JP Morgan's $6,300 target by December 2026 is not a conflict prediction. It is a debt cycle prediction with a conflict accelerant. Ray Dalio has spent 40 years watching investors make the same mistake during every geopolitical shock. They react to the conflict, they ignore the cycle. And the cycle is always the one that matters. Dalio put it this way in his framework on geopolitical shocks and debt cycle positioning. In 40 years of managing capital across every major geopolitical crisis in the modern era, I have found one consistent truth. The shock is never the story. The shock is the event that reveals the story that was already there. The Iran war is not the reason gold is at $5,100. The Iran war is the event that accelerated the conclusion the monetary system was already building toward. The conclusion that the reserve currency power is carrying too much debt, too much inflation pressure, and too little fiscal flexibility to absorb another external shock without further debasement. Gold is not reacting to the bombs. Gold is reacting to the balance sheet behind the bombs. He continued. The three-phase pattern I have observed across every geopolitical shock since 1973 is structural, not coincidental. Phase 1 produces maximum emotional volatility and minimum informational content. The investors who trade Phase 1 are trading fear, not data. Phase 2 produces the repricing, the moment when institutional capital, which does not trade on emotion, begins positioning based on the structural consequences of the event. This is when Goldman Sachs models are updated, when JP Morgan raises price targets, when Morgan Stanley publishes sector rotation frameworks. Phase 2 is where the money that will be made in Phase 3 is positioned. And Phase 3, the rotation phase, is where the investors who understood the mechanism collect returns while the investors who panicked in Phase 1 watch from the sidelines. He closed with this. In 40 years, I have never seen a geopolitical shock that permanently destroyed the investment returns available to a patient, framework-driven investor. What I have seen consistently is the shock creating a window, measured in days, sometimes weeks, during which the patient investor can position into the structural winners at prices that the emotional seller has just vacated. The Gulf War produced 18% S&P returns during the conflict. Iraq War produced 13.6% in 3 months. Russia-Ukraine produced an S&P rebound above pre-invasion levels within months. The pattern is not a promise. It is a 500-year data set. And in 40 years of managing capital, I have found no better guide to where patient money should be positioned than the patterns that history has confirmed repeatedly, without exception. The market scorecard from the first 10 days of the Iran conflict confirmed every element of that framework. Defense stocks. Northrop Grumman up 6%, RTX up 4.7%, Lockheed Martin up 3.4% on March 2nd. Global defense stocks broadly gained across Europe and Asia. Germany's Hensoldt, Britain's BAE Systems, Japan's Mitsubishi Heavy Industries, all moved positively. Morgan Stanley confirmed the structural thesis. Defense spending drives multi-year procurement cycles, not single-session spikes. Energy. Brent crude closed the first week above $85 per barrel, up nearly 30% year-to-date. WTI approached $80. ExxonMobil, Chevron, ConocoPhillips all closed positively. The pipeline and storage infrastructure operators, the Phase 2 opportunity, remain less visibly priced by retail attention.